Okay, here we go. Welcome, family childcare business owners. I am Jamie Simpson, the assistant director of our Family Childcare Business Network. And tonight, again, we have our wonderful certified public accountant, Mr. Muhammad Alim with MMA CPA Incorporated with over 18 years of experience. So, again, get ready for a treat. Get ready to learn, get ready to ask questions because you are going to walk away tonight with so much information and just be really fired up to get your business organized, your family childcare business. So, welcome again, Muhammad. Thank you so much for joining us in this hour, and I'll turn it right on over to you.
Awesome. Thank you, Ms. Jamie. I also want to say thank you to QCC and thank you all very much for joining me. Happy New Year to everybody. This is the time of year for us to talk about the awesome topic of taxes, how to get ready for it, and mastering your tax preparation for 2024. And so with that, let's jump right in. What I have for you all today essentially is a couple different topics. We're going to talk about some housekeeping on the beginning end with the BOI, which is the beneficial business owner, which is something that came up that kind of is a little confusing. And so I'm going to take you to the website and we're going to review what the requirements are, who's required to do it. We're also going to talk about taxes, tax planning. We're going to talk about bookkeeping. So a lot of really exciting topics. Before we jump into the presentation, because today's presentation is an hour long, if there are questions that you have, if you can, please submit them. If we do not get to all of them today, I do promise to either record an answer video or respond via email to all the questions. So do not worry if we don't get to your questions today. The goal is to get to all of them, hopefully before the end of next week. Okay? So with that being said, let's jump right in. A little bit again about me. I've been in business, in practice since 2006. I primarily work with small businesses. I do specialize in the childcare industry for both family childcare practitioners and center owners. And I've been doing that for better part of about 7 years now, where we've been doing these webinars and also focusing and working with providers of all sorts throughout the entire country. So now let's jump right into my first topic and let's talk about what this BOI filing requirement is, because this is a very confusing requirement. And so in preparation for this meeting, the date of the deadline initially was January 1st. And so what this is the IRS is requiring all business owners, LLCs, INCs, partnerships to report on who the beneficial owner is of those entities. And so, for example, if you have an LLC, you are going to put into the FinCEN system, which I'm going to show you in a second. You're supposed to report who the beneficial owners are. And so normally, if it's an LLC that you own, you would put your information along with the LLC and submit that. If there are partnerships, you would put all of the different partners. Everybody that is a beneficial owner of these entities needs to report. Now, what happened in the middle of the fourth quarter is there were lawsuits for people that are challenging this requirement. And so sometime in the middle of December, this requirement went away for everybody, which meant that the January 1st, 2025 deadline, which was yesterday, no longer applied. In the middle of last month, they reinstated it with a new date of January 13th. That was again struck down a little bit later. I want to say sometime earlier this week, it was struck down. And so now it's a voluntary submission. So your question to me is, well, how are we going to know whether we're required or not required? Now, let me take you to where you're going to get this answer. This is where you're going to be able to get that answer. This is the FinCEN, which is the Financial Crimes Enforcement Network. This is where you're going to be making that submission for the BOI. The latest update is setting this as a voluntary submission only, which means if you submit, you are submitting this voluntarily. There are no penalties associated with not filing it. But because of the rapid changes, it's changed since Christmas twice, where they reinstated it for the 13th of January, then they stayed it, we don't know if there are going to be changes that come up in the next couple of weeks now that people are back to work. And so definitely look out for this website. Be on the lookout on the news. It should also be reported on the local news. But this is the most up-to-date website where they're going to be able to inform whether or not this requirement is due. If you said to me, can I just go in and make my submission and file it and just do a voluntary submission? That would not hurt you. If you went in here, it should take you all of about 5 minutes. All you would need is your information, the company's information, the LLC, tax ID number, and address, along with your personal information. The submission should take you a few minutes to do. So if you wanted to go ahead and submit it in lieu of them reinstating this, which is what they're looking to do, from all of the court filings and the appeals, I would say definitely go into the website and submit it. You don't need to pay anybody to do it. You are able to submit this on your own. If you do need assistance, there are companies that do that for you. We are also a company that does provide that for you. But as a first step, I would say try to submit this on your own. If you do then need help, definitely reach out. Okay? All right, so with that being said, now let's jump into the tax planning portion of the presentation. And I know I've talked about this a lot. We've talked about tax planning. We've talked about the benefits of tax planning. Today, I wanted to actually show you the software that I use to be able to do some tax planning. But before we get to that, let's talk about what tax planning is in a general sense. And so when you're filing your tax return, in April or March or even January or February, if you're filing it early, what you're essentially doing is you're reporting your annual income for the prior year with all of the expenses, and then whatever is left, which is going to be your profit as a business owner, you're going to have those taxes that are due. What I see in practice a lot is that is the first and only time that people know what they're going to owe is when they're about to file that tax return, which is really not a good way to do your tax planning or even to do your cash flow, because you're not wanting to find out that you owe X amount on the day that it's due. You would want to kind of do a little planning beforehand, maybe in the last quarter of the year where you're essentially projecting out and figuring out what that liability is. Now, tax planning only works with bookkeeping, which is going to be what we're going to talk about next. But once you have your books together, once you have your income and your expenses together, the next part is to be able to say, well, what am I going to owe for 2024? And so with that in mind, let me take you over to the tax planning software that I use. And I'm just going to walk you through this on a fairly quick, it's not going to be as detailed as I would like, but I want to kind of essentially show you the benefits of what tax planning is and what it can do for you. And I will tell you, this is a feature that most preparers are able to help you. They might not have the same software, but the tools are essentially the same, okay? So don't worry, this is generic information. So it's my name, tax plan. I just threw in some information in here. The tax year that we are looking at is 2024. And the important information that we're adding in here are essentially two parts. The first part is the business that I'm submitting. And so my business that I'm running is under a sole proprietorship. You're able to run it under an S Corp, a C Corp, or partnership. But for most family childcare practices, you're filing a Schedule C, either as an LLC or as a sole proprietorship, okay? I'm including my income. Most, on average, what I see is around $50,000 to $75,000 in revenue. And so I threw 50,000 as my estimated income. And then the rest of the expenses are expenses. And so again, these are estimates. I'm just putting numbers together. But the main thing that I would look at is I'm looking at a financial like this, I would say, well, why don't we have office expenses? Well, that's only $250. That's too low. Subscriptions, you should have Zoom, you should have your Kid Care maybe, or your Parachute, or your Pro Care subscription. Why aren't those in there? And so looking at this, I would always examine it to see what is missing, what is not missing. But since this is just a generic example, I do want to just kind of show you the end result. But that's the way I would want you to always look at this profit and loss, is to be able to say what expenses are missing that I normally spend money on. Supplies, which is the food, maybe educational supplies, that's there. If you have contractors or wages, we should have something in the wages and salary section. But just make sure that you're kind of scanning this as we go through this to see if you're missing any of these expenses on your financials. So once we're done with this portion, then I would go into the personal part. And if I'm filing a married filing joint return with no dependents, I would file it this way. If I'm filing a single return, if I'm filing as a resident of Alaska all the way to Hawaii, to Georgia, you're able to pick the state that you're a resident of. And so in this case, I'm going to say married filing joint and that I'm a Georgia resident. The dashboard now gives us the net result. And so this is now where we start coming up with the plans. And so $50,000 of income, we have $23,000 of profit from my childcare business. I have a W-2 of $25,000. My tax liability for 2024 is projected to be $2,624. So now, the first thing that I want you to imagine when you do the tax planning session, the one thing that you have an advantage over when you file the return 3 months later is at least you know as an estimate what your liability is going to look like 3-4 months before. So if you did this in November or December, you would have known this 3 or 4 months out before you actually have to pay this $3,000 tax liability. Okay? So now that we have this number, your question is, well, what can I do? What can I do to reduce my liability? Allow me to give you an example real quick. Let's just say you wanted to invest money into your traditional 401k or IRA in this example. If we put $7,500 in an IRA, now mind you, this has to be an IRA and not a Roth IRA, but watch what happens to the liability. So $7,500 goes into an IRA. My liability drops by a couple $100 on the federal side, and now I get a refund on the state side. And so you're like, okay, that makes sense. If I'm filing married, filing joint, maybe both of us put money into a retirement account. So $7,500 for me, $7,500 for my spouse. Now, what does that do to my liability? Drops it even further. It allows you to plan on what your expenditure is going to be for taxes. It allows you to also plan on what your retirement is going to look like. And so this is the benefit of what tax planning is. And if this is your first meeting with me, this is the first time I'm kind of showing the software of what tax planning is. Normally we talk about it. We never actually show what the end result is. But essentially, this is what a tax planning tool is supposed to do for you. We're also able to project out for the following year. We're also able to say, well, what is that number going to look like if we were to go to 2025? If my income goes up, if my income goes down, am I better off filing one way or the other? Let me give you an example real quick. Let's go back to 2024 and let me come back to the business. Let's say you switched your entity from a sole prop or an LLC that filed as a Schedule C to an S Corp. What are my tax savings? In prior meetings, I would normally say $30,000 is where I would want you to switch. Let me just show you what that looks like if we were to switch right now. So if you were to switch from a Schedule C to an S Corp, you're getting a refund on both the federal and the state side. Now, does this make sense for you to file this way? Most likely no, because now you're filing two different returns. So there's an additional cost. There's also a requirement with the S Corp that you have to have payroll, but this is essentially how you're essentially paying in taxes all you want to pay in taxes. If you said, I don't want to pay X amount, what do I need to do to be able to minimize my liability? There are a million options, from spending in 2024 to putting money in a retirement account to 529s to health savings account. And the list goes on and on and on the things that you're able to do to minimize that liability. Remember now, if you were to find this out in April of 2025, so when you're about to file, at that point, you're a taxpayer. At that point, you're not going to have, it might not even make sense to put $15,000 in an IRA. You might not have the budget to do that and the taxes. You might not have the budget to do an S Corp and the Schedule C. So planning makes a lot of sense. And this is one of the benefits of being able to do the tax planning. And you could see the greens on this tax plan. So this person would have gotten a refund of $2,000 instead of paying $3,000 with a little planning. Okay. And I'm sure you're going to have questions about this. And if you do, please send them on, and I'll do my best to answer them towards the end of the meeting. But essentially, that's what tax planning is. And again, the main part of it is making sure that we have our books. And so, with that being said, let's go to the first step of the 2024 tax prep, which is bookkeeping. Even if you weren't going to do the option of doing the tax planning, bookkeeping is going to be your first step, even for the tax prep. Okay. And this is something that Ms. Jamie, Ms. Michaela, Ms. Monique, and I kind of always reiterate with family childcare. You're wanting to do your books daily, not weekly, not monthly, not quarterly, because you have 2 or 3 or 4 transactions that are happening maybe every other day. And so it's such a small number of transactions that it makes sense that once you close at 6 o'clock, let's just say you spend 3 minutes to go in and put the expenses into your system, whether it be a Playground or a Procare or a QuickBooks. You go in and you actually itemize your expenses as you go, as opposed to waiting either for the weekend or for the end of the quarter or the end of the year. What you don't want to do is wait for when the tax returns are due, because at that point you're essentially rushing, right? In practice, what I normally see is you'll have a client that will try to put their books together right before the tax prep, and we would then say, hey, your liability is X. And they'll say, oh my God, I've got this account, or I've got that account, or I've got expenses that we pay through PayPal. What you're wanting to do is you're wanting to kind of do regular bookkeeping on a daily basis. At worst, if you're doing them, do them every other day or at the end of the week. Do not save all of the books for the end of the year, because you're not going to remember what you spent money on in January of 2024, right? If you're like me, you're probably not going to remember what you spent money on Monday this week. And so it makes sense to kind of itemize as you go on what you're spending on the business, especially if you're separating everything, right? So making sure you separate finances is really, really, really an important part. You should have a business bank account. You should have a personal bank account. You should be paying for expenses out of the business account that are business expenses, and then personal for personal. Okay? There should be no commingling of funds, even if you are running. Let's just hypothetically say that you have a sole proprietorship and it's a business that you're running under your own name. Although we say that that's not the best way to run a business, you should have a separate business account for your business activity. It should not be commingled with your personal. It's going to be almost impossible to figure out what that cash out was for if you took on an ATM withdrawal on an account that is mixed for personal and business. You're not going to remember. If it's a business account, you're going to have those receipts, you're going to have those expenses. That'll be a lot easier for you to categorize as you go. Reliable tools. So having, say a KidCare, a QuickBooks, a Brightwheel. There are very many softwares that you're able to use that are in the space of family childcare. And the main thing that separates them is whether they do or they don't use the time space. That's the one big factor that we've seen in practice, whether they do use the time space or they don't. In your case, you want a software that does use time space, because that is something very important. It'll allow you to pay a lot less in taxes. But that is the main difference between a lot of these different softwares. We're not promoting one over the other. It's really the end user that should dictate it. So it's whichever one you feel comfortable with, whichever one you kind of are able to navigate, that you should go with. But using Excel is not really a solution, or writing down on a piece of paper. I would definitely say having an automated system and automation is the way to go, as opposed to doing it manually through Excel. And then maintaining your records in case of audits, in case of reconciliations, in case of having an examination of some sort. Tracking your expenses and receipts is really a very, very big key to bookkeeping. And so all that would mean is, if you did have one of these software tools, it would allow you to take a picture of your receipt as you go, and it would record it and keep that for you in their storage system. And so, if there was an audit, if there was an exam, a reconciliation, what have you, you would have those documents when they were required. Okay? So bookkeeping, again, is our first step. That is the main thing. taxes cannot be done until bookkeeping is done. In practice, I would always say, if a client comes to me and says, well, I need to get my taxes done, I'm like, are your books done first? The tax part is second. I can't even advise you on the planning, on reducing your taxes, on retirement strategies until we know where you are with your year-to-date financials. Okay. And so first step is bookkeeping. That would be really our starting point. So now that we've talked about bookkeeping, let's talk about key deductions. We did talk about the time space. Time space, again, a very, very big expense. Where you normally are going to see this on a tax return is a form called an 8829. Essentially what that is we're taking the house that you are currently working out of. And this is the house you're living in, and you're taking care of the kids in. We're looking at that house as a split off house. If it's a house that you're using exclusively for work, that you are renting as an office, that entire property is an expense for you. So time space really wouldn't apply because the entire thing is a write-off. We're talking about is mixed use properties where you're sleeping in some parts of the house and using the others for work. That is really where the time space comes in. And essentially what that is we're looking at, let's just say it's a 2,000 square foot house. 1,000 square feet is the portion of the house that you use for both storage and for learning and for the kitchen and what have you. And you're using that X amount of hours in a day times the whole year. That would then essentially tell you what portion of those household expenses you could write off as a percentage. And so time space is a very easy calculation as long as we know what the square footage is and how many hours you're open, plus the additional hours that you use those spaces, like say today's webinar, these would be additional training. This would be additional hours that you're using that space. And so making sure that today, when you're done with this meeting, to go in and say 6:30 to 7:30 on the second, we used it for a webinar. This would be, a way for you to be able to expense a little bit more. It's not going to be a huge difference, but it adds up. If you're doing a training webinar 3 times a month, 5 times a month, times 12 months, these add up. And the more they add up, the lower your tax liability. So it's a dollar for dollar reducer of your liability if you were just to keep track. And that's all that's required, is you keeping track of your hours. Okay. And so meals and snacks is another one. This is something that in our chart of accounts that we've created for the family childcare, we're calling that a supply. And so cost of goods is something that I see in practice. Cost of goods is if you had inventory and you're selling it. As a provider, what you're essentially doing is you're buying the meals and you're serving them right there. You're not selling them, or you're not storing inventory. And so meals and snacks would be a supply. I would say, as a bookkeeping thing, the worst thing that you can do is if you went to Sam's and on the same receipt bought personal and business expenses on that same receipt. That would really be a bad thing when it comes to bookkeeping, because you're not going to know where to cut off. You might know of that one receipt, but if that's a normal business habit, it's impossible to separate those down the line. And so making sure that we have separate receipts, we don't commingle. We write off all the business expenses for the kids, whether it be a breakfast, a lunch. If you have early drop-offs or late pickups, if you're providing snacks, all of these would be business expenses that you could write off. Okay, so snacks, meals. If you're meeting providers, let's just say you are going to say QCC and you're having a business meal with, an accountant or a lawyer, these are expenses that you can write off. The main criteria now for business meals for you to be able to write them off is they need the business purpose of that meeting. And so if you just went to Starbucks because you wanted to, you're not going to be able to write that off. Or if you went to Benihana's, as an anniversary dinner, you can't really write stuff like that off. What you're wanting to do is to document the reason why you're at that facility. And sometimes they might ask who you were with. And so if it's a legal meeting or an accounting meeting or a potential client meeting, you would want to be as specific as you can on your documentation when you're doing the books to be able to say that's the reason why you spent X amount at that restaurant. And so those would be business expenses. You just need to make sure that we itemize the why you were spending that money. Okay. Supplies and materials, educational supplies. If you have training materials, if you have the desks, the tables, all of those are expenses that you can take off and completely write off. All we would just have to do is just make sure that these are business necessities and expenses that you are incurring in the business. Um, if I could give you an example on what would be a deductible, non-deductible expense, the way I want you to think about this is, in practice, what the IRS would do if you were ever unlucky to be audited, what they would do is they would do a physical walk-in of your business. They would come into the doors and actually physically inspect what's in there. And so if the business expense that you have is more of a personal lounge chair, or it's a TV that you use in your room and things like that, it's not going to pass their inspection. And so you shouldn't put that as an expense. If something, as if they're walking in, is a business write-off, it's something that looks and is being used as a business item, at that point, go ahead and write that off. And so remember, at the end of the day, they're going to do a physical walk-on in the business if you are being audited. And so if it doesn't pass mustard at that point, then we have a problem. We want to make sure we don't get to that on the front end. We want to make sure that on the front end, if it's not a business write-off, we leave it off. Okay?
Can I add something to Muhammad to that slide that you just stated? Can you go back for 1 second? I want to add something for everyone. So when Muhammad spoke of adding the time and calculating the use of the time, like he mentioned, tonight you're in a training, you're in a webinar. There are no children present in your home. You're still contributing time to your business. It counts. And so even though, as he mentioned, it's 1 hour, still recorded. So those of you that are already using Kid Care Parachute, I know, and as well as Playground, I know that there are places in that software for you to be able to record that. Go ahead and record it like right now. You know, it's 1 hour tonight. Go ahead and do it now. Get it out of the way. Make that a habit. Every time you get ready to join a webinar in the afternoon, when the children leave, when you're doing something related to the business, not just webinars, but anything, planning for meals, any type of paperwork, if you're doing lesson plans, if you're talking or giving a tour to a parent in the afternoon when there are no other children present, go ahead and record that time. Get it out of the way so that way you don't have all of that piled up on you. And then again, if you don't use your software right then and there, find a tablet. Go ahead and record it in your tablet. And guess what? Everybody has a cell phone. Put on your calendar. Add it in your calendar to what you did and how much time you spent for that. The other thing is, I want everybody to this year, please make sure that you take pictures of your receipts. So go ahead and start getting into the habit of taking pictures of your receipts. Again, some of you have software where you can upload the receipt into your software. Because guess what? We all know that when we get receipts, the ink begins to fade away. And so, again, that's still no excuse that the IRS, if they're looking to see how much money you actually spent on different expenses for the business, and you say, well, I had it, but I don't have it anymore, that's unacceptable. So you want to be sure to have a copy of that to make sure that you have a very good record. So go ahead and find an app. If you don't have software to upload the receipt into your software, I know Playground has that feature, but if you don't have an app, go ahead and begin to take pictures with your phone. Actually, download an app so you can take pictures with your phone, and that way you can organize and better categorize your receipts. Easy ways to do it. Do it right now. Don't wait, because again, if you wait, it's going to continue to pile up and pile up. And guess what? You're going to get into a place of being possibly stressed out, and it's just going to continue to compound on you. So do it every day, as Muhammad mentioned. Okay, and that's it.
No, these are beautiful points, great points. Let me jump on top of them a little bit and just kind of talk about the receipt one. So in practice, if you have a faded receipt in an audit, it's a non-starter. They're going to take that expense out. They're going to make you pay taxes on that as income, and so they're essentially going to take out that expense. A lot of people assume just because it says Home Depot on their bank statement or their credit card or Walmart that the IRS is going to assume that is a business expense. You can go to Home Depot and buy soda or gum or, a lot of their uh, candies. The IRS needs to see what you actually physically bought from these stores to be able to say, are these business expenses, yay or nay? And so that's why the receipt is important. And just as Jamie emphasized, taking a picture of it right there and then as you're going makes sense. And putting that, whether it be on an online storage device or in the software that you're using, is critical, because if you don't have the receipt, that means the expense doesn't exist. Okay, so that's the first thing. And then I would say, as far as the planning part, if let's just hypothetically say, and I know it's nobody in this meeting, but let's just say hypothetically that you hadn't done your books from 2024 and 24 just ended. The best way to go is to still do your daily bookkeeping for 2025 today and catch up on the prior year. What you're wanting to do is to build good habits now and still catch up. If you were to say, you know what, until I catch up, I'm not even going to worry about January because I don't have to worry about that until next year, you're essentially putting yourself in that same bad habit of you're just getting ready for tax season. So you have to do the daily bookkeeping as you go and still do the catch up. Maybe the catch up is your weekend work, and then every day you're doing a little bit of your bookkeeping as you go. And so making sure that you do both really is key. If you've caught up and you're doing everything that you're supposed to be doing, just do it daily and you should have absolutely no problems. Okay? Thank you very much for that, Ms. Jamie. That was really some excellent points that you raised. And I'm sure everybody here kind of benefited from that and from your experience as well. Now let's talk about tips and common tax mistakes. The one thing that I believe I learned from either Jamie or Michaela or some of the excellent providers at QCC is there are a couple different ways that you can generate revenue as a family child care provider. Although I do accounting and tax representation, I've actually never run a business before. And so as we're going through these webinars, we had folks that shared ways that they were generating revenue, like the late drop-offs and early pickups and kids that were coming in that weren't fed breakfast that you're essentially charging to feed. These would also be revenue that you would need to recognize under the business, okay? And if we're talking about the time space, going back to that, if you're accepting early drop-offs and late pickups, that means you should increase your hours of usage. It shouldn't be 6 to 8 or 8 to 6. If you're doing early pickups, early drop-offs and late pickups, that means your hours are extended. And so therefore your hours should extend when you're doing that time space calculation. Okay? But those additional revenues that you're generating from either having parents that bring kids that are not fed, or they're picking them up late, or maybe there's a weekend service that you're giving to the parents that wanted to, spend a little time together. This would all be revenue that you would need to recognize. So the number one mistake that I've seen providers make is that you don't report all the income, and you want to report all the income. Do not assume because it's cash that they're not going to track it. Cash they have tracking systems for almost everything. Okay. And the one thing that we looked at a second ago, which was that BOI submission, the reason why they want people to submit that information is so they can build a database on who owns what. So they're able to then audit folks that own multiple businesses that are cash-based. And so this is more of a database building platform. And so what we're wanting to do is we want to do the right things. We want to report all of the income. And I promise you, if you are doing what you're supposed to be doing, your expenses are going to be there. What I've seen in practice is folks that would underreport their income because they don't think they have the expenses, because their tax liability is so large. They're like, oh my God, there's no way I made that much, so therefore the income is not as high. Reducing your income is a legal situation that could result in jail time, because remember, all of these tax returns we're signing under penalty of perjury. And so underreporting is a cardinal sin we don't want to do. What I would rather you do is report all the income, but go through all of your expenses on a daily basis to capture all the business expenses. If you're doing that, I'm never worried about the income. As a tax preparer, when I'm preparing a return, I tell clients, doesn't matter what the income is. Like literally does not matter. Because if you have the money to pay it, it would be in your account when the tax liability shows up. If it's not there, then there is a hole somewhere. There's a business expense somewhere, unless we're just frivolously spending this money. There is a business expense somewhere that is not being captured in your books. And so we just need to audit it to figure out where all of this money is going. Because if you're doing the right things with your business income, there should be enough expenses to write off against that income. Reducing that income isn't the way to go. That's a big no-no. So making sure that you report all of your income is really one big key. Second one is the separating of the personal and the business. And I know this is the second time we're mentioning this. The reason why I'm doing that is because this is something that I see in practice, and not just in the industry that we're in today. I'm talking about every industry across the board, whether it be lawyers, whether it be doctors. There's a lot of commingling of funds. And what you're wanting to do is you're wanting to separate that. What I want you to imagine is if you're a bookkeeper that is tasked with the assignment of trying to figure out what these business expenses are, and you see personal, you're going to assume this person is spending almost everything personal on that card. You're going to move most of these items in personal if there's a question mark. Where if this was a strictly business account, even if it was an ATM withdrawal, you would put that as under uncategorized expenses, because we know that there's a reason why there was ATM withdrawal taken out. 100% has to be business. There's got to be a receipt that goes with it. Where if there's commingling, your knee-jerk reaction as a bookkeeper is going to be, this is probably personal. And when you're looking at it as the business owner, you're going to say, mix everything. I have no idea. That's probably personal. What you did there is you lost that write-off. What you did there is you increased your tax liability. All because we're mixing the two. We're mixing business and personal. If you separated the two, at least it gives us a fighting chance to be able to say, you know what? You had an expense, there was a repair, you hired some folks that maybe were Home Depot workers, or you hired folks that maybe you paid as a contractor. What's the logic of why you took X amount out of that account? Where if you're spending it from both, most likely it's going to just be a personal expense. And so my number one thing today would be bookkeeping, again, number one, making sure that we do that and we do that regularly. The second one is making sure we have separate personal and business accounts. Yes, we recommend setting up LLCs, but if you said to me, I have a sole proprietorship, well, you should have a business account for that business. It's still a business that you should have a separate account for. Credit card, checking account, what have you, all of that should be separate. If you're needing to move money over and then to spend it how you would like, you do a withdrawal, an owner withdrawal, you put that in the personal, and nobody ever gets to see that. If it's a business expense, it needs to have a reason why money came out. And it'll be much easier for you to track. If you went back to January of 2023 or 24, you're able to say, well, this is an expense for business, that's an expense for that. If everything is mingled, it's almost impossible to know. Okay? And then clearly classifying workers. This is one that I've seen in the family childcare industry a lot, which is troubling sometimes. And so IRS is a very clear explanation on who a contractor is and an employee is. Plumber, contractor. If a person who comes in to work, whether it be after school, whether it be at certain times in the morning, if they're doing what you're telling them to do, if they're there when you tell them to be there, these are employees that need to be paid under a W-2. If it's a plumber, it's a contractor, 1099. So that would be the clear difference. If you're telling them what to do, where to be, how to do their job, W-2. If it's a plumber who comes in and you're like, just fix the problem. If it takes you an hour, 10 hours, that's your problem. Just fix it. That would be a 1099. So making sure that we clearly distinguish the two is key. Why? Because if you pay the person the wrong way, that liability falls on you. Department of Labor might have a problem with that. They might make you pay taxes on the employee's income on money you never collected. So now you're out taxes that are not going to benefit you. And so you're paying somebody else's taxes because you called them a contractor instead of an employee. Another thing that I've seen in practice is you're paying family members under the table. Essentially what you're doing is you're inheriting their liability. You're inheriting their tax liability, whether they're under Social Security or if they're under some type of a government benefit. Paying them under the table isn't an acceptable way of paying anybody, because all you're doing is you're opening yourself up to liability, A. B, you might be penalized, and the penalties sometimes are double what you didn't pay this person. And 99% of the time, it's the person who you are paying that way that reports you. And so what I would say as an advice is pay them the right way, pay them what they're supposed to be paid, and do it the right way on the front end, so you don't have to then pay taxes on insane amounts or be penalized or have the risk of a state agency shutting you down as a business, because you're doing things to help people. You're not doing them to harm them, but you're essentially hurting yourself by trying to help them, and you're really eventually not helping them. Okay? So definitely classify these workers appropriately. They're W-2, pay them as such. Contractors, pay them as contractors. So now, as far as the key deadlines, there are a couple that are coming up. And so January has the W-2s and the 1099. So these are contractors and W-2 employees. If you have W-2 employees, normally this is automated through your payroll system. If you're using a payroll provider, I know ProCare is the only one that does payroll through their system, but with them, you have to print out the material and mail it. But almost all the others, if you're using ADP, Paychecks, they'll do that for you. And so the deadline for that is going to be this month. 1099s, you're manually going to do that. You would need a W-9 to be able to get the information of the contractors, and then you would submit that 1099 to the IRS. Essentially, why you're doing that is in order for you to take these as business write-offs, somebody else has to pay taxes on this income. So plumber has to pay taxes on his income. That's a tax write-off for you. If you just said, I paid it and nobody paid taxes on it, therefore you never gave a 1099, the IRS might challenge you and say, well, nobody paid on it. You never gave anybody a 1099. We will not accept that you can take that as a tax write-off. Okay? The second deadline on the screen is the March 17th deadline, which is normally the March 15th, but they move these around because of weekends, is the S Corp and the partnership. Again, most family child care providers do not operate under a partnership or an S Corp. These are more, if you have a business that's got more than one owner, and the S Corp is if you're generating a profit of 30,000 or more per year, which is the way that you should be filing, because it'll reduce your tax liability. As we saw in that tax planning session, or the tax planning example I gave earlier, if you were to switch from a Schedule C to an S Corp, you go from paying taxes to receiving a refund. And so we're wanting to look at that as a possibility if you're generating profits of above 30,000. And the deadline for that would be on the 17th. The key thing on this deadline is that the S Corp partnerships, those are the two returns that have late filing penalties. So if you're late per month, there's a $210 late penalty per month that the IRS charges. And so making sure that those are extended, if not filed, is really, really important. The final deadline is the one that we're all familiar with, which is the April 15th one. This is the one where you're filing either as a sole proprietorship, a single member, disregarded entity. If you're filing a 1040 personal return, this is the deadline that everybody's familiar with, that we're filing a personal tax return. And this year it falls on April 15th, which is the normal date. And that date right there, the key thing to remember about the 15th is if you file an extension, the extension only allows us time to file, not to pay. So if you owe $2,000 in April, they wanted you to pay the $2,000 in April, not in October when you file that return. So if you were to file an extension and pay in October, there's going to be a late payment penalty, even though you have an extension. Okay? All right, so with that, we are now in the Q&A section. Any questions, Ms. Jamie, about any of this before we look at any of the questions?
We do. Yes, we do. We actually have two questions in the chat. And so Ms. Linda asks, how long should you hold on to your receipts, and how far can the IRS go back?
So CID, if you underreport on your income by more than 25%, it's lifetime. IRS can go back as long as they need. But normally 3 to 6 years is the window that the IRS audits. And so if you're reporting all of the income, 3 to 6 years would be the time that you would kind of keep all of your receipts. And so making sure that they're digital is really key, because I think after a year and a half, most of these receipts fade. Even if you keep them in pristine conditions, they'll fade after a while. But if you're looking at a window, it's 3 to 6 years where the IRS would normally audit you.
Awesome. Awesome. Good advice. And so the next question we have is from Miss Shaquan Dean. She's asking, my lawn guy needs a W-2.
No, so your lawn guy normally should get a 1099, but if a W-2 would be somebody who's working in your business. So lawn guy comes in on Tuesday, sometimes on Thursday, sometimes when it doesn't rain. So he would be more of a plumber. And if it's a house expense, if it's like, let's say it's a place that you're actually renting, then you would get a W-9 and you would give that person a 1099, because that is an entirely business expense. If it is a house that you are residing in, you do not have to give them a 1099, because some of that is personal, because this is a shared space calculation that we're going to be able to take off. And so if you didn't give them a 1099 to the lawn person, you're fine. But remember, when you're giving a 1099, if you give it to them under your personal name, you're going to use your social and your first and last name on that 1099. That's why it's really important to also have a business. If you're giving a 1099 out, it should be under your business and not under your personal.
Okay. So we do have some other questions here. We have Zadian Carey just asked, should I still file even if I don't have any registered kids? I started in October, but don't have any official registered kids. I have startup expenses and I own, and yes, I have startup expenses.
So the answer is yes. Now, the IRS requires you to file taxes. If you generate $600 or more in income, you are required to file. So from a requirement standpoint, if you don't hit that $600 income limit, then you don't have to file. But because you have startup expenses, that is actually going to generate a refund for you against your personal W-2. So it makes sense to file that tax return from a tax, position, but the IRS is not looking for you to file anything because you didn't make over the $600 limit.
Okay, awesome. And so the next question we have is from Miss Linda Clark. She says, do you still give out a 1099 to an established electrical company?
An established electrical company. So if Georgia Power is essentially giving you the electrical service, or you have an electrical company that comes out and does work for you, if it's a shared house, for the most part you don't. But if it's a rental property, then for the most part you would. Even if, as a CPA, I would get 1099s that are issued in my name for work that I am performing that I'm getting paid on. And so it depends on if this is a shared property or if this is 100% exclusive business use. And so if it's 100% exclusive business use, every contractor gives you a W-9. Every contractor gets a 1099.
Okay, and then we have Miss Pamela. These are some great questions, you all. Miss Pamela says, what do I give my parents to show how much they pay for childcare?
Great question. So there is an official form. It's a W-10 that allows you to put your information. So when you're doing a 2441 from the parent side, you're needing to list the name of the entity, the tax ID, the address, and the amount. That is all reported on a W-10, but you can also do it on a letterhead. I've seen that probably more common than I have on the actual tax form, where you give them a letterhead that has your information, it has the child's name, and it also has the amount. If you have more than one child for that household, you would separate the kids and then you would separate the amounts. A lot of the times it's almost like a receipt that you're giving them, and it might have each of the payments for each of the children for the entire year. But as long as they have the EIN, the address, the name, and the amount for each child, That's the document that they would need in order for them to file the tax return.
Awesome. So the next one that we have is from Miss Dawn Bridges. What's the late fee for LLCs if you do file for an extension, and how long can the extension last?
So LLC is a loaded question because an LLC can be a Schedule C filer, it can be a partnership, it can be an S corp, it can be a C corp. So an LLC could be one of a million things. So let's just hypothetically say you mean an LLC that filed as a Schedule C. An LLC that files as a Schedule C, the extension is April 15th is the due date. The extension is 6 months to October. There is no late fee if, like, let's say you're getting a refund. There is no late fee on a refund, right? The IRS has a 3-year rule that if you don't claim your refund within 3 years, you lose it, but they're not going to charge you a late fee on a refund. The late fee is normally on if you owe a balance. If you owe a balance, there is a monthly charge that the IRS charges. It's 0.05% per month of whatever the balance is. And so it depends on the amount and it depends on when you actually pay the balance. And so if you paid the balance, if you filed an extension in April and paid in June, that's going to be a smaller amount of penalties than if you paid in October because they're charging you per month.
Okay. You all, these are some awesome questions. Just one more, and then what we're gonna do is let's see. So what's an EIN?
An EIN is a tax ID number that's separate from your personal. So whenever you're going into a bank, if you're getting a license, they need a tax ID. And so if you're running the business under your personal name, you would use your social. If you're running it under a business, it needs to have an EIN, which is an employer identification number, commonly known as a tax ID number. They're essentially the same number. The main difference between the two is your social is 3 numbers dash 2 numbers then 4, where the tax ID is 2 numbers dash 7. Same 9 numbers, they just separate them differently, but that number is assigned to that business name. And that EIN could be assigned to a what they call a fictitious business, which is not an LLC. It's essentially you running a sole proprietorship, but it's under a name of a company. There's an EIN for that. There's also, you can get an EIN for an LLC, an EIN for an INC or a partnership. All of them are free. You can get them from the IRS website. But you have to remember with each of these tax IDs, there might be a requirement, there might not be a requirement. So pulling them willy-nilly is not really the way to go. If you pull the payroll number, there's a requirement every month. There's a requirement every quarter. And so making sure that we're pulling the right tax IDs for the right purposes is really key. But to answer the generic question or to answer in a generic way, a tax ID number for the business is an EIN. You have a social, which would be your number as a person.
I also just dropped a link down in the chat too to the Provider Resource Hub. If you log in the Provider Resource Hub, it's going to give you so much information, a whole summary about what an EIN number is, some more documents, and then also if you need to apply for one, that link is also in our Provider Resource Hub. And so if you need help with that, let us know so we'll be able to assist you all with that. Dawn, also, I'm going to circle back really quick, Muhammad, because I know we're about to end. Dawn just wanted to know, so she says, so only if I owe as an LLC, I get charged interest. So that's what she's wanting to know. So only if she owes. This is for the question about what's the late fee for the LLC to file an extension and how long can the extension last?
Only if you owe, if it's an LLC that files as a Schedule C. Now, remember now, if it's an LLC that files as a partnership, there is a late filing penalty for not filing, right? But we're not talking about that. We're talking about a Schedule C, right, that has an LLC that files as a Schedule C. If you do not owe and you're getting a refund, there is no interest, there's no penalty on that on the personal side. So that is correct. If you do have a balance that is due, the balance is going to then generate interest and penalties.
Okay, she says, got it. It is a Schedule C. She said, okay, thank you. So thank you. We did have some other questions. I'm going to stay on you all for a few more minutes. Muhammad, we thank you so much for sharing this information. If anyone else wants to drop questions or if you have some questions for Muhammad, I am going to send them to him. I can stay on again so I can collect these questions from you if you want to send them to me in an email. But again, I thank you all so very much for joining us tonight. Muhammad, again, thank you for this information. Very valuable information for our family child care owners. But everyone have a wonderful night. If you still have questions, I am going to collect them again and I will be sending these to Muhammad so we can send them out so everyone will have their response. Thank you all so much. Again, I'll be on.